Welcome to the debate, where we examine substantive disagreements emerging from critical financial material. Our source material today lays out 5 foundational numbers for successful retirement planning: spending, Social Security, savings rate, tax bracket, and time horizon. We are zeroing in on a pivotal question: which of the two primary levers, the controllable savings rate or the immutable time horizon, is the most powerful determinant of a retirement plan's final outcome?
And this tension here is, well, it's not merely academic, it's incredibly practical. We're pitting the power of agency, the savings rate, which the material aptly calls the superpower, against the relentless arithmetic of longevity. The mathematics embodied by the time horizon or the multiplier. The core disagreement is whether control over input or certainty over constraint ultimately defines success, especially for those who get a late start.
And I'm going to argue that the savings rate is the foundational number. It's the primary lever of control that maximizes compounding potential. Really, it's the only variable entirely within an individual's immediate control, giving them the ability to overcome the constraints imposed by, say, a shortened time horizon.
And I come at it from a different angle. While the savings rate provides the fuel, the time horizon is the unyielding structural constraint. It dictates the necessary longevity and sustainability of the entire portfolio, and it can render even the most aggressive saving, well, insufficient if the required duration is too long. The time horizon just sets the boundaries of what's possible.
Okay, so my core claim really centers on maximizing the exponential power of compounding through the savings rate. It is the single most important factor because it's actionable and its effect on accumulation is nonlinear. The source material offers a pretty clear illustration of this using the case of a 45-year-old late starter. If that saver simply maintains a modest contribution, they accumulate a respectable amount. But if they adopt the step-up plan, aggressively escalating their savings rate from $500 monthly up to $1,500 monthly later in life, the difference is staggering. That change in input created nearly a $330,000 difference in the final principal by age 65.
And that scale of difference in principle is, it's undeniable, but it's still only half the equation.
Absolutely. And this is where the savings rate truly earns its title as the superpower. The material demonstrates that, in this scenario, contributing an extra $120,000 in principal resulted in the portfolio rewarding the saver with an extra $126,000 in growth. The market didn't just match the effort, it amplified it. This nonlinear effect means that the market gives you significantly more than $1 back for every extra dollar you choose to save. So while longevity is a biological fact, the time horizon, maximizing the savings rate is the operational tool that lets the planner truly leverage the market and generate the critical mass needed to secure the rest of the plan.
I acknowledge the kinetic energy of a high savings rate, I do. But the size of the accumulation only matters when it's defined by the time horizon. My position is that time horizon is the foundational constraint because it determines the safe withdrawal rate, or SWR, which is the ultimate measure of a portfolio's utility and sustainability. The SWR dictates how much income that principal can actually provide annually, and that, not the principal amount itself, determines retirement success.
Right. Can you explain the magnitude of that distinction for our listeners?
The evidence is compelling when we analyze two hypothetical retirees, both starting with the same $750,000 portfolio. If retiree number one only needs a 10-year bridge, a short time horizon, they can comfortably sustain an 8% withdrawal rate. That yields $60,000 per year from their capital. However, retiree number two, needing to sustain their lifestyle for 30 to 35 years, a long time horizon, must be dramatically more conservative, adhering to a withdrawal rate closer to 4.5%. That same $750,000 now only provides about $34,000 a year.
Wow, that is a punishing reduction in spending capacity.
It is. And the time horizon dictates that enormous strategic variance. A long duration introduces critical sequence of returns risk. the chance that a major market downturn early in retirement just cripples the portfolio permanently. To mitigate this risk, the time horizon mandates a conservative SWR and necessitates a much more stable asset mix. Aggressive saving can't fundamentally change this mathematical constraint after the fact. Time horizon is the multiplier because it sets the geometric rules for what any saved capital can sustainably provide, thereby setting the essential standard for the entire plan.
Core debate. So this brings us directly to the primacy of constraint versus the power of input. You focus on maximizing the input, the savings rate. But the ultimate output, the sustainable annual income, is absolutely limited by the time horizon.
If a person requires $50,000 a year for 3 decades, no amount of increased saving can bypass the necessity of that conservative 4.5% withdrawal framework imposed by the long duration. The time horizon, through the SWR, places an absolute mathematical cap on how much they can spend relative to their principal.
That line of reasoning sounds, deeply pessimistic, particularly for the late starter, because it implies the constraint is insurmountable.
I see why you think that, but let me give you a different perspective. If the time horizon is long, say 30 or 35 years, then maximizing the savings rate becomes a fundamental necessity precisely because the constraint exists. The long duration means the financial requirement for durable income is exponentially higher. You're right that the SWR is lower, but that only increases the importance of aggressive funding. If the goal is the durability required by the long time horizon, well, the only way to achieve it is by aggressively funding the portfolio to a size where 4.5% is sufficient. The time horizon multiplies the required capital, sure, but the savings rate is the only active tool we have to generate that capital. You are describing the savings rate as a necessary response to the time horizon, not the primary driver. The time horizon is the master variable because it dictates the target.
I would argue that its operational primacy rests in its ability to bridge the gap the time horizon creates. Let's integrate the evidence again. If the retiree's desired spending is $50,000 and the long time horizon limits their $750,000 portfolio to yielding only $34,000 per year, they have a $16,000 annual income shortfall. To successfully retire, they must grow the principal until 4.5% of the total equals $50,000. And to reach that principal, the savings rate is the only tool available. The time horizon sets the impossibly high hurdle, but the savings rate is the lever used to clear it.
That's an interesting argument, though I would frame it differently. The strategic variance imposed by the time horizon demonstrates its dominant role. The fact that the duration of life can swing the sustainable withdrawal rate by almost 400 basis points from 8% down to 4.5% proves it. This single factor dictates the entire risk profile, required asset allocation, and spending capacity. The material notes that for a shorter horizon, the risk of bad timing, sequence of returns risk, is minimal. For a long horizon, it matters dramatically. The time horizon is the operating system, the savings rate is just the data input.
I'm not totally convinced by that line of reasoning because it treats the principal amount as static. While the time horizon dictates the maximum safe withdrawal rate for a given portfolio size, a sufficiently high savings rate provides the flexibility to choose an even lower, safer withdrawal rate, even if the horizon is long. By accumulating significantly more wealth, the retiree can absorb market volatility and drastically reduce the pressure imposed by SOR.
But the risk is still inherent in the long timeline. A 30-year time frame demands that you hold growth assets, stocks, to counter inflation and ensure long-term sustainability, even if you save aggressively. If the market collapses right after you retire, that is SOR, your large principal is immediately depleted. The constraint of time forces exposure to that volatility.
And the high savings rate buys insurance against that volatility. It provides the financial latitude to use larger cash reserves or to implement a dynamic spending strategy where the retiree can spend less during market downturns. This ability to tactically withdraw less money during a bad market is a freedom directly purchased by having a larger buffer, a buffer built by maximizing the savings rate. The savings rate transforms the long time horizon from a terrifying risk landscape into a sustained period of long-term compounding.
But the fundamental decision to allocate conservatively, to prioritize durability over short-term returns,
is dictated entirely by the time horizon. If you plan to live 35 years, you must behave differently than someone planning to live 10 years, regardless of how much capital they have. The longevity constraint defines the behavior.
Okay, that's a key intersection. I would maintain that the plan for the full lifespan, the time horizon, is the ultimate architect of the Social Security strategy.
Of course, the longer the time horizon, the more critical it is to delay claiming Social Security up to age 70. This maximizes the inflation-adjusted, guaranteed floor for the duration of that long life expectancy. The material highlights that a 65-year-old woman today has a high probability of living 2 decades or more, forcing the planning horizon to extend well into her 90s. That longevity is what sets the ultimate non-negotiable goal for Social Security optimization.
Exactly. Delaying Social Security is essentially buying longevity insurance, which is only necessary because of the long time horizon. It is a strategic mandate imposed by the duration of life.
But a high savings rate is the only practical means to execute that strategy. The optimal strategy, delaying Social Security, requires the retiree to fund the bridge years from age 62 or 65 until 70 out of their own savings. A high savings rate is essential to build the necessary portfolio to cover that safe income gap before Social Security kicks in. Without aggressive savings, the retiree is financially forced to claim Social Security early simply to cover baseline spending, thereby undermining the time horizon-driven strategy and potentially putting their longevity at risk.
It assumes the person could have saved more, though. But what if the required bridge is too long? If a person retires at 60 and needs to bridge 10 years until age 70, the time horizon, the duration of that required bridge, is the problem. The savings rate may have been high, but if the required lifespan of the portfolio is 40 years, the withdrawal rate drops so low that the bridge funds become disproportionately difficult to accumulate. The time horizon defines the financial burden.
I see that, but the actionable solution is still the savings rate. If the plan fails, it's a failure to maximize the controllable input to meet the non-negotiable duration. The longevity is a fact, the funding level is a choice. We're discussing primacy of influence, and the savings rate offers the experiential influence required to counteract that duration constraint. It's the active element constantly shaping the outcome.
Conversely, the constraint of the 30-year withdrawal rate fundamentally limits the utility of every single dollar saved. This constraint imposes an absolute cap on annual sustainable spending that the savings rate alone cannot remove. It only increases the principal needed to meet that cap.
But if the goal is to reach that cap, the savings rate is the only path. Conclusion. We have analyzed how these two numbers interact, but my argument remains fixed on actionability and exponential impact. The savings rate is the crucial lever. It's the only number entirely within one's control that provides exponential return, that market amplification, and the financial flexibility necessary to fund the bridge years and cushion against market volatility. The savings rate empowers the planner to proactively manage their future and meet the goals defined by their lifespan.
And I maintain that the time horizon is the ultimate defining factor. It dictates sustainable spending through the SWR, it sets the risk tolerance, and it demands a specific conservative portfolio asset allocation. These are fundamental, immutable constraints that aggressive savings must operate within. The time horizon is the frame of the portrait, and the savings rate is the paint applied within that frame. If the frame, the duration of required income, is too large, no amount of accumulated principal will solve the underlying strategic challenges.
It dictates the scale of the challenge. The savings rate dictates the capacity to meet it.
It sets the limits of what is geometrically and mathematically possible.
While we disagree on which number holds the superior position in the hierarchy, both the controllable input and the external constraint are undoubtedly crucial. They act as the engine and the chassis, respectively, in shaping any successful retirement plan.
Indeed, successfully considering both the non-negotiable duration of life and the achievable rate of accumulation provides the comprehensive clarity needed to navigate the complexities of long-term financial planning, revealed in our source material.